All right, thank you, everybody. Thanks for joining us this morning. And Matt, Mike, Lorraine, Jim, thanks for putting on such a great conference as usual. This is my 20th one.
33.
Yeah. But yeah, I think this panel is going to talk about tankers, and we've got 4 panelists from some of the leading companies in the sector, and we'll talk a little bit about big picture, fundamentals, supply, demand, and we'll get a little bit into the companies. We'll also do a little bit more of a short-term and medium-term discussion, and I'll just do a quick introduction. We have Lars Barstad from Frontline, Tony Gurnee from Ardmore, Mikael Skov from Hafnia, and Carlos de Mottola from D'Amico. So we're led by primarily a product panel, but we also have Lars with the VLCCs and obviously the large products. I'll do kind of I'll ask a few questions to get things started to the panel, and then I will ask a few along the way directly to the specific panelists, and feel free to cut in and rebut if there's opportunities. But maybe first question is going to be to everybody. Maybe we can start with Lars and go on down, but generally, the tanker market has been strong for the past 2.5 years. It's been transformational. And I wanted to ask if you could tell us, how has this market changed your company? And also, what are you looking forward to doing over the medium term, assuming this market continues to stay strong?
To speak, yeah. No, so this has been kind of a untypical period we've been going through. Frontline has 3 major asset classes, and we've had kind of an inverted earnings relationship benefiting some of the other guys at this panel. We, for Frontline's part, we still believe in economies of scale. We believe the bigger ships will prevail at the end of the day, but I must admit, for the last couple of years, that's not been the case at all. So we've seen the smaller to medium-sized asset classes prevailing, probably primarily fueled by the unrest in kind of the conflict between Russia and Ukraine. So I think this has kind of changed a little bit of the logics of the market. But I think that's probably, if you're going to sum it up, the biggest kind of challenge we've seen, at least.
So I'll state the obvious and the not so obvious. The obvious is that we've had a chance to significantly delever. What's not so obvious is that interest rates in the meantime have gone up a lot. So that, for example, our break even with the leverage we had 3 years ago would have been probably over 17,000 a day, but now it's below 13. The other not so obvious is that we've been using quite a bit of capital to upgrade the fleet to improve its performance, and that's really showing.
Thanks. Yeah, well, I guess in continuation of that, Tony, we've obviously been able to pay back our shareholders, which has been nice, and a lot of patient shareholders who've not been able to get good dividends. I think one of the other challenges and stuff that we are spending time on is preparing the organization for a period of change. In other words, we're entering a phase where if you are a tanker company, at some point you need to go through a transformation in the energy complex. There's a lot of technology things that's going on, and I think if you just leave the organization without any form of embracing change, you could run the risk of having an organization that will get a bit into panic, and instead of maybe grasping some of these opportunities, be afraid of change and therefore set the company back going forward. So we're starting already now, pushing a bit for innovation culture and making sure that people are not scared for what will come, but rather will be curious and start to embrace and position ourselves for what will happen, admittedly, over a longer period of time.
Yeah. On our side, of course, we delivered also substantially. We were 73% leverage net financial position to fleet market value at the end of 2018. Last quarter, we were at 11.5%. But we were also lucky to have a lot of purchase options that we could exercise. We started exercising some of these on some time chartered in vessels. We are going to be exercising more in the near future. And we also had the opportunity to order recently some LR1 vessels, which are going to be delivered to us from 2027. and they're going to be a great addition to our fleet. And of course, we were able to start remunerating more our shareholders with more dividends and also through buybacks. And we look to do more of that in the near future.
Thank you. And Carlos, maybe just to follow up with D'Amico, you recently took over the CEO position. I know you've been with the company a long time. How are you thinking strategically for D'Amico? Any changes you plan to make? Anything that you see the company doing differently going forward than what you did in the past?
Yeah, thanks. No, so I was, before taking this new position since April, I was the CFO for 8 years of the company, so I shared most of the decisions which were taken. So it will be management in continuity with the past. Of course, the landscape we operate in is changing very fast, and so there will be new opportunities that will emerge and that at the right time we will seize. We will continue investing to keep a modern fleet, also through exercising the remaining options I was referring to before. Looking at new technologies that we can adopt to make our vessels as efficient as possible. And also looking to distribute more cash to our shareholders in the future. We haven't done that much of that so far, especially relative to our peers. We have focused more on the deleveraging, but that is going to be more of a priority going forward.
Thank you. Lars, this one's for you. You have spoken publicly recently just about the shortage of tankers that are going to start to show themselves, and you've talked some big numbers. And it certainly tells us that the outlook is fairly strong. But could you maybe just talk a little bit about what you're seeing with respect to how we're 100 or I forget the number, how many hundreds of tankers we're short, and how we're going to fix that?
No, we are going to be short. I don't know if any of you watched Rystad yesterday on this panel or on their presentation. They're pretty smart. They're looking at this kind of underinvestment in oil. Jeff Curry, formerly Goldman Sachs, now Carlyle, I believe, he's called it the revenge of the old economy. And basically what we're pointing to at Frontline is this massive wave of building that we saw leading up to 2011. Now, kind of putting the long goggles on, we're kind of looking at an order book which is stretching into 28, soon 29. And by 3031, by normal metrics, we need a lot of replacement, particularly in the tanker space, but it's also affecting all the other asset classes. And unless we believe that we're going to gradually reduce oil consumption, which even Rystad didn't before he started to talk about windmills, he actually confirmed that they believe we're going to peak on demand side around 2030. We have a structural problem here. So this is, this cycle different from the earlier cycle, or 2004 to 2008. 2004 to 2008. Sorry. That was a demand-driven cycle. Now we are in what I believe a supply-driven cycle, and we don't even have, we don't have half the capacity on the building side that we had in 2011. So this is kind of an interesting thing that's playing out here. And looking at the previous presenter talking about asset prices peaking here, but seriously, we've had inflation close to 30% in Korea since 2008. We haven't had 30% inflation in asset prices from the peak we saw in 2008. So I think kind of inflation, we are in an inflationary environment. We've been that in all, basically, asset classes and commodities globally, apart from shipping. So I think actually we're only embarking on this voyage, and it's going to be very interesting to see how it plays out.
Yeah. Interesting comments, Lars. Thanks. And just a follow-up. One of the main themes, as you said, this is a supply-driven cycle. There's a lack of shipyard availability. Shipyard capacity is much reduced relative to where it was, say, 10 years ago. Are you seeing any expansion opportunities that the shipyards are undertaking? Is there any meaningful amount of capacity that you see coming on to sort of combat or take advantage of the high new building prices and limited slots available? Anyone willing to take that?
No.
Very limited.
Very limited, yeah. So still early days on the supply side. Michael, maybe just kind of following up on, Lars was mentioning, was it Rystad, you said that mentioned peak oil in 2030. A couple weeks ago, the IEA said something similar. They mentioned 29 as a plateau for oil demand. I guess generally, and Michael, it's for you, but anyone feel free to take this on as well. Do you believe in that? And then if we are close to peak oil consumption, which has obviously been talked about for a long time, what does that then mean for your business and investing in whether it's investing in further tanker assets or do you diversify?
Yeah. Well, I mean, I don't think that it will probably be a bit arrogant to say that Hafnia has better intelligence than, some of these big agencies. So I do think fundamentally that if you look back in history, in particular around the COVID, that generally people have been too conservative when we talk about the expectation for oil demand growth. And I think we're seeing the consequence of that, as Lars mentioned. We underinvested for a long time because everybody felt that this transition was going to happen overnight. And now we're kind of stuck in a way with a problem where we see oil and gas continuing to grow. So, in our view, yes, we still see growth ahead of us. It's very difficult to see what the alternative should be in a meaningful way within the next 5 to 10 years, quite frankly. So when you ask about, so how do you see that and how do you want to invest? Quite frankly, my biggest worry is that we're going to run out of tankers too soon. That's my biggest concern. I think that we need more ships, and new builds are pretty expensive at the moment. But if you look at the age profile, I think that that's going to be the biggest challenge: is how do we continue to supply tankers to cover the demand that will come. I think that the transition, and it will happen eventually, will be, I think, in a slower pace. And as an investor, I think we have to take it step by step. I think it's a bit early to say what is the right way to go, but I think if you have a strong ongoing business that's stable with a healthy balance sheet, that gives you the finance to do the transformation when it arises, I think that's the position you want to be in. You want to have as much length as possible, as much scale as possible for the current business to enable you to move across when and if that starts to happen.
And sticking just with the maybe kind of the new building cycle, and just it feels like we're continuing to be taking 2 steps forward and two steps back when we think about what's the right propulsion of the future. A year ago, it felt like ammonia maybe was grabbing the reins as the favorable one. That seems maybe to be shifting, but just wanted to get your perspective. Maybe Tony, how are you seeing the?
So I think, unfortunately, and I agree with everything that Michael just said about the transition taking longer. So unfortunately, at least for the next generation of ships, the fuel of the future is probably fuel oil. And so the key then is efficiency. And obviously, being capable of being converted to something else. But I think it's, there are technological issues with ammonia and safety, et cetera. But there's a huge issue around availability. So, I think we just have to be realistic about that. But the thing that's very actionable today is both technical and operational fuel efficiency.
So if you were to order a ship, I'm not saying you would, but if you were to order a ship, how do you equip that?
It would be conventional with a highly efficient ship, conventional with some kind of dual fuel ready status.
Anybody else?
No, I think it's important to remember that we are here to kind of save the planet, but we're also here to make money, and we have to, otherwise we won't invest in transportation. So and so far the kind of economical prospect of investing in these relatively costly technologies is very difficult to defend. But I have to say that over the last couple of years we've had a lot of volatility in dual fuel LNG. So basically LNG has kind of played themselves out of for tankers at least, or deep sea transport. But this is coming back in play again. So I'm optimistic that all of us, when we order a ship, will retain the option. But I think we might actually over the next few years see people kind of similar to us actually call on that option to aim for, say, dual fuel LNG, and that is a big step going forward. Basically to retain the optionality as LNG pricing is coming kind of down to more normalized territory.
Can I add to this, Omar, as well, that I think it's also important that we keep in mind that we go through this transformation with our clients. And I think there's been this trend of trying to, front run certain things. I mean, I'm a firm believer that we obviously need to stay close to our clients and listen to what are the needs. Back to what Lars said, we're running businesses, and I think the the prime thing is to make sure, do we know what our clients want to go, and follow them, right? I think it's a logical way to go through a transformation with your clients rather than trying to front run it or second guess it. So I think that will make it stronger, more reliable, and ultimately have healthier businesses on both sides actually coming through a transformation.
I guess there's a lot of conversations in shipping, especially for tankers, that this cycle feels very much like it felt back in the early 2000s. But there's also differences, perhaps, that I'm assuming that are prevalent. I certainly, I think, see some. But maybe if I could just ask each of you to comment maybe on how you've lived this cycle, you've lived the last cycle. How is this one different? I think, Lars, you may have touched on that already, but
yeah, it's we're not expecting exponential growth in demand from Asia, kind of propelled by China. That was touched upon in the previous presentation as well. India is obviously an exciting market for oil and coal, for that sake. But I think this is sincerely a supply-driven side. We've all kind of lost enough money kind of after 2008 in that period to hopefully stay disciplined at least for a couple of years more before we pile into this cycle. So I think it's going to be kind of supply is the big, and Mikael kind of touched up on it earlier. Kind of the actually pre-COVID, a lot of agencies were advocating peak oil. This month, we're actually, according to EIA, consuming 103.85 million barrels per day. It's a new all-time high on oil. I don't think anybody back in 2019 expected that, to be quite honest. So I think the sad reality is that we are going to continue to use hydrocarbons for the foreseeable future, and now actually logistics hasn't it is not really prepared for that.
Tony, maybe this one's for you, just in terms of equity valuations, and then what does that then induce a management team to do? We've seen, I guess Ardmore specifically, but generally across the tanker sector, we've seen valuations improve. We've been talking about that for the past several months. But now you have stocks trading above NAV, which it theoretically means investors want to reward you now for growth and investment. Do you agree with that? And then is that something that compels you to make investments?
I think maybe a point to start with is that for a long time it felt like NAV was the limit, regardless of how the company was doing or what the actual NAV what it was. But there was a perceived limit because above that, investors felt that shipping companies would just go out and issue and dilute them and kind of knock the stock back. I think for the time being, those days are over because we all have enough money to do what we need to do. So I think it's kind of safe to come out and go above NAV and think more holistically about valuations of shipping companies, and certainly in our sectors here. Everybody's flush with cash. There's fairly limited opportunity for reinvestment. I think we're all taking our own path in that regard. Like I said earlier, I think we're very focused on improving the performance of the fleet, the fuel efficiency, et cetera. That's been a good use of proceeds. Continuing to pay down debt, paying out 1/3 of our earnings and dividends. So I think we're kind of in a good place, and it's a fairly safe place for investors in terms of the risk of capital issuance.
Thank you. And I guess maybe just to follow up, either Tony or for anyone, looking at it from the Wall Street lens, there's always like a view of, okay, above NAV, issue stock, below NAV, buy stock. I guess generally, how do you, strategic decisions and how you operate the business, is that a separate function altogether than your valuation? If you know what I mean, like how do you strategically operate the business and then also look at the NAV at the same time? Does that affect it?
Can I pass on that? Hear someone else says?
Anybody?
Or I'll start.
Yeah.
So my thinking immediately goes to capital allocation. Okay, and we've got a very well-established framework. It served us well over the last 3 or 4 years. Strategically, we all know what we want to do, which is to renew and build our fleets wisely, meaning at good relative valuation, et cetera, or pricing. That seems to be pretty hard right now. So I think at least we feel like very, very gradual, staged fleet renewal, almost to hedge against the upside, because, I think we were talking about cyclicality earlier. I think we're in a very, very strong upcycle now, which only happens roughly every 15 years. And so I think there's a case to be made that this, we're still, in like the third or fourth inning. So how do you then manage a fleet where all of our fleets are aging, in that context? So we're engaging in very gradual fleet renewal.
I think for Frontline's part, we kind of, decided to do it a little bit differently from our peers. We've actually used this opportunity to lever up, to basically, increase our fleet, having less equity behind it, offering kind of quite good returns on our, to our investors if we're right. So we've kind of been atypical in this manner. Frontline will always pay out, earnings by way of dividends, but we've actually decided to consciously increase our leverage in this market because we don't believe values are at the top yet. And also we believe that we're at the first inning or whatever, first base, whatever it's called in
Third inning.
I guess that's been one fundamental difference, perhaps, relative to the cycle that started, say, 20 years ago, was companies it seemed were levering up the more we proceeded in that cycle. Lars, you mentioned you've added on some leverage, but even then, asset values have come off, have risen, so your leverage has come off actually.
Yeah, it's actually a challenge to keep your LTVs high enough because asset prices are moving so quickly. But joking aside, we've at Frontline at least, we've made a conscious decision increasing our kind of voyage days exposure by 50% the last year. Maybe at least now the jury's still out, but initially maybe the VLCC doesn't look as the most sexy market right now, but we believe that's going to prevail. But I think kind of the key here is that it was mentioned every 15 years you have a cycle like this. At least we see a lot of similarities to what we saw in 2002 to 2008, but again supply driven rather than demand driven. But that's basically where we're placing our money.
Mikael, your leverage ratio has come down quite a bit. Tony, yours is low. Carlos, yours is low. But generally, then, do you agree with what the Frontline approach of adding on more leverage here, or do you like keeping the balance sheet lean?
No, I mean, for us, we've taken the view that we look at kind of mid-cycle valuations, and we found a level that we're going to be comfortable with on a mid-cycle valuation, and we're not very far from it, I think. And at that point, I think we'll leave the leverage as it is. I mean, we have tied up our dividend policy with the net leverage, and that's kind of how we've done it. So the more we reduce, the more we pay on dividend. But I think we're probably not far away from where we want to be. We don't want to be debt free. We don't think that's an efficient use of capital. But we do see when you look at mid-cycle versus where we are today in valuations, obviously the numbers look a bit different. So that's the way we've approached it. So we link those two, and my guess is that as I said, we're not far from where we want to be, and we want to make sure we keep a good relationship to the banks as well. I think, as I mentioned earlier, the whole transformation that we're going to be going through at some point is going to be very expensive. I mean, we're all going to be out there raising lots of capital, both debt and equity, to finance new ships, whatever they will be. But if you even look at today, ammonia carriers versus our medium product tankers today, right? This is like a 3 times up. So if you want to continue to have scale in the business, it's going to require a lot of capital. So I think it's important to keep a good balance now, so that we still have banks that would like to talk to us when that time comes.
Makes sense.
No, on our side, I would say it's actually quite a similar reasoning. I mean, we do recognize that maybe our current balance sheets are not optimally structured if you look at the situation today. But if you take a longer-term view, I think there's a lot of value to having financial flexibility, which would allow us to seize opportunities when they arise. And as we mentioned, we are, which is a big difference from the previous cycle we were referring to, the 2002 to 2008 cycle. We are now facing an energy transition, which is happening. We don't know how fast it will be happening, and probably our sector is going to be impacted slightly later than other shipping sectors in this respect. But things will change. There's a lot of R&D going on in different fronts, a lot of new technologies coming up. which makes our vessels more efficient. But I wouldn't be surprised if yards come up in a few years' time with radically new designs, new propellers, which are much more efficient, even for conventional fuel vessels. And therefore, we want to, we don't want to, just not do anything. So we invested recently on 4 LR1s, which are actually more efficient than the vessels that were delivered to us in 2019. That's part of our fleet renewal. They will be replacing some older vessels we will be selling in the coming years. But we think there's going to be even more opportunities going forward that we still cannot see today. For investments, and therefore we want to keep this financial flexibility and have low leverage to be able to seize these.
Thanks, Carlos. Maybe just kind of like on the tanker market outlook itself, if we think about it, there's always different durations we can look at, but maybe just simply, since we're at mid-year, thinking about the second half, OPEC is keeping barrels off the market, refining margins have moderated from their very high levels, yet rates seem to be hanging in there. And hanging in there at very strong levels, excluding VLCCs. But what's the outlook for the second half of this year? How do you see the market developing?
That's a big question, and I've had it a few times this week so far. Probably going to have it more times. But no, it's right now it looks like we're in a kind of ignoring the Red Sea, Gulf of Aden transit situation, which is obviously affecting the clean products market specifically. We're probably in a normal seasonal market as we were last year as well. I'm a bit scared for putting too much expectations into second half, because exactly 1 year ago we're sitting here and had lots of expectations for second half, and it actually it didn't really materialize until potentially going into Q1. But listening to the experts, we're supposed to increase global oil demand by close to 3 million barrels in second half. So that's going to tighten things up. But I think kind of considering where we are now, we're north of cash break even for all asset classes. All on this panel are actually making good money. And this is we're entering the summer lull.
Yeah, I'll just briefly make the point that, MRs are, earning about 45,000 a day at the moment at a pretty unusual time of year. Second half usually is when you get a seasonal pickup, and even strong markets are volatile, right? So, might go down, up again, etc. But
yeah, no, I concur with that. I think you're going to see the usual seasonality, which means we're going to see a very strong second half, but you're still going to have that volatility, right? Just at higher levels, and I think I just want to remind people as well. We talk about the Red Sea, and obviously it's a big situation for the world in general and for us. But I don't think we should forget that in 2022 and 2023, before the Red Sea crisis, earnings were very high on product tankers as well. So I think this latest overreaction, when there was a bit of talk about the situation may be evolving or not, I think we should just remind ourselves that with or without it, we are still in a very, very strong freight market, and the 2022 and 2023 were super strong, and it still allowed us to pay out large dividends to our shareholders.
Yeah.
Yeah, and just to add to that, I agree, and I think actually we're going to see quite a strong summer probably, as refined volumes are expected to increase and be at their peak around July and August. And then, of course, we might have a slightly weaker September, October, and then the usual pickup in November and December. But in addition to that, we are in a unique scenario where we are going to be facing very low vessel deliveries, extremely limited fleet growth. So if the trade disruptions that we are benefiting from today persist, we are in for a very good second half of the year.
Yeah. Thanks, Carlos. All right, and just final 30 seconds, just a quick one, and feel free to talk your book. Just want to start with Carlos to come on down. Favorite tanker asset class over the next 18 months?
We recently ordered the LR1s, and we are very happy with the performance of our LR1s. I cannot comment on the LR2s. They might be doing great too, but we don't have them on our fleet. So.
Yeah, no, very much agree. LR1s have been great for us.
of course, I love MRs, but I think VLCCs are pretty interesting. So.
Thank you very much for that. It's there's the thing called economies of scale, and actually for our clients, it's transportation cost is the big one. basically cents per barrel. They don't really care about the asset class specifically. So I think kind of it's about time the VLCC start to shine.
Great. Look forward to it. Thanks, guys. That'll wrap it up there.